So we'll now start with reading number 23 of the level 3 curriculum that will teach us the concepts of equity portfolio management. So as we studied in the previous review on fixed income portfolio management, we have done our asset allocation. Let's assume 60% we have allocated to equity and 40% we have allocated to fixed income or debt. How to handle and manage the fixed income portion specifically, we studied in the previous two reviews. We will now see that what will we specifically do about the equity part of the total asset allocation. So the asset allocation call has already been taken. This is the systemic exposure that the client wants to equities, and we'll now see how we can invest in equities as best suited for a particular client. Now, in a portfolio, there's no doubt that equities are needed. Equities particularly serve as a very good inflation hedge. If my company had sales of $100 last year, costs of $50, and a resulting profit of $50, in the coming year, if I do no incremental expansion and I do no incremental volume growth, however, there is an inflation in the economy to the extent of 10%. That is, the prices of, let's assume, everything went up by 10%. My selling price of goods would also go up by 10%, so the revenues would go up to 110, costs would go up to 55, and the profits would increase to $55, or there would be a 10% increase in the profits in line with inflation. Had I invested wealth in a fixed income security, then if I got a $10 coupon last year, then regardless of inflation or deflation, I would have continued to receive $10 every year depending on the maturity of my bond. So if you're expecting deflation in the economy, then fixed income securities are generally a better bet because their value in present value terms will grow as the discount rate falls. If you're expecting moderate inflation, then fixed income instruments will lose value. Equities would be a good inflation hedge because your earnings would grow in line with inflation. Of course, from company to company, it will depend whether it can pass on the inflation or it can pass on more than the inflation or less than the inflation. But generally, moderate inflation is good for equities. Equities are considered to be a good inflation hedge while bonds are not. Higher tax rate can reduce returns, and ability as an inflation hedge depends on the competitive position within the industry. Just like we studied in fixed income portfolio management, the equity fund manager can adopt a passive approach wherein he just replicates his benchmark or whatever is the mandate given to him. So when you've assigned an equity fund manager, you would normally assign a benchmark as well. So the fund manager's mandate would be to invest in equities. So just because he's bearish doesn't mean he can pull out 100% of the money from the market and just invest in fixed income, because that can distort your overall asset allocation. So the equity fund manager specifically would not be given so much freedom. His job would be to invest in equities, and the performance indicator would be outperformance over a particular benchmark. In a passive strategy, we don't deviate much from the benchmark. That is, we hold securities in the same proportion as they are present in the benchmark. As studied earlier, the expected return in such a strategy will also be low. When we say expected return, we mean expected active return, that is the return over and above the benchmark. However, the tracking risk will also be lower. Tracking risk is the volatility of the active return, that is the return on the portfolio minus the return on the benchmark. As we move from passive to active management, enhanced indexing with small risk factor mismatches. So we are not as specific in equities as we were in fixed income, but generally the concept remains similar. We will start deviating a little bit so as to at least outperform to cover up our expenses and our administrative costs, because otherwise a passive management or a purely index strategy will always underperform to the extent of the management fees and the administrative charges. So in enhanced indexing, we'll try to deviate slightly so as to at least cover up those costs and be in line with the benchmark. In full-blown active management, there is no regard to the benchmark. We invest in the stocks that we think will give us the best return, and that's it. So the expected active return will be the highest, but the risk of severely underperforming the benchmark will also be the highest in the last approach. So information ratio is defined as the active return upon the active risk, also known as the tracking error. Active return is the return on the portfolio minus the return on the benchmark. We can do this calculation over the last many years or many periods and calculate the average active return, calculate the standard deviation of the active return. The standard deviation of the active return is called active risk or tracking error or tracking error volatility. All these terms mean the same thing. Suppose there are two managers, gamma and alpha. Calculate the information ratio and comment on their relative performance. So active return for gamma is 0.5% and for alpha is 0.8% with a tracking risk of 10% and 20%. So if we divide the two, we will get the information ratios for gamma and alpha. So for gamma, this comes out to be 0.05, and for alpha it comes out to be 0.04. So what we can conclude is that even though alpha has a higher active return, adjusting for the higher risk that he is taking, the performance of gamma is better, or as given by the information ratio, gamma is performing better on a risk adjusted basis. So for every 1% in tracking risk, gamma delivered a 0.05%, but for every 1% in tracking risk, alpha delivered 0.04%. Now, depending on the situation of your client, you will decide whether to go in for a passive management strategy or an active management strategy. So if your investor is highly taxable, both in the short term and the long run, then being too active, that is buying and selling too much, will have a big tax implication. So in such a scenario, it is better not to recognize too many short-term capital gains, and it is better to follow a passive strategy. If the investor believes that the markets are efficient, or if he believes that fund managers cannot add much value, then again it calls for maintaining your systemic risk exposure but not trying to time the market or do a selection. Large cap stocks and markets where the investor lacks experience, again we will advise that follow a passive strategy to take exposure. So at level 3, once again we will review the equity weighting schemes that we studied at level 1 and 2. However, we will now discuss the more qualitative aspects and the concerns about each of these schemes. So we have to give our equity fund manager a benchmark. The benchmark is a collection of stocks weighted in a particular manner. The weighting can be a value weighted index, also known as a market cap weighted index. The weighting can be simple price weighting, a free float adjusted market cap, or an equally weighted index. There can be other weightings as well, but these are the common examples of how we get to a number for the index. Now, let's assume there are 3 stocks, A, B and C. The stock price or the current market price are as shown. The number of shares are also given. So A has 10 million shares outstanding, or let's assume A has 10,000 shares, B has 100 shares, and C has 1 share outstanding. And that's the composition of the index. So the composition means these are the stocks that form a part of the index. However, that's not the job done. The index has to be one number eventually. Hence, we have to weight these 3 stocks in some manner so as to arrive to that one value for the index. In a price weighted index, we simply take the average of the stock prices to compute the value of the index. So do 10 plus 100 plus 1000 divided by 3, and that will be the value of a price weighted index. As you can see, the only advantage of this index is that it's fairly easy to calculate. Apart from that, everything about this index is counterintuitive, because if you were to replicate this index, that is, the performance of your portfolio should be the same as the performance of this index, then where would you have to invest the maximum amount of wealth? Because C is $1,000, or C has the biggest impact on this index. So you would have to invest considerably higher amount of wealth in C, even though it is the smallest company. Even though if we compute the market cap, it's 1000 into 1, just $1,000 market cap, much smaller than A and B. So in a price weighted index, the biggest stock price has the biggest weight, not the biggest company or not the undervalued company or anything like that. So it's counterintuitive to the regular sense in investing, and it generally won't make sense to give a fund manager a price weighted index to follow. In a market cap weighted index, the weighting is in proportion of the company's market caps. So the market cap of A is 10,000 into 10, that is $100,000. Market cap of company B is 100 into 100, that is $10,000, and market cap of company C is only $1,000. So now company A will have the highest weight, and company B and C will have a relatively lower weight. C will have a very low weight because it's a very small company. The advantage of a market cap weighted index is that it is the bigger company, and preferably the more investable company that has a higher weight. The disadvantage is that a higher market cap may be because the stock is already overvalued, and hence the market cap is high and the company is big. If we are to replicate the index based on a market cap weighting scheme or this kind of an index, then we are essentially being asked to invest more in a company that is already overvalued, which may not always be the right thing to do. A free float adjusted market cap index is similar in calculation, only the number of shares is not the total number of shares outstanding, it is only the free float number of shares outstanding. This is done to enhance investability, because it is assumed that the promoter will not sell out or other closely held stock will not be available in the market. So company that has a higher free float market cap will have a higher weight in the index. That is, instead of the total number of shares, we will only use the free float number of shares in computing our weights or computing the sizes of the companies. In an equally weighted index, please understand, all stocks, regardless of their size or stock price, have the same weight. So the weighting is very easy to calculate. If there are 5 stocks, what will be the weight of each stock? 1 by 5, that is 20%. If there are 3 stocks, the weight of each would be 1 by 3, that is 33%. So in an equally weighted index, all prices or all stocks have the same weight. Advantage of this index is again simple to calculate and easy to replicate. So to replicate an equally weighted index, just invest equal proportions of your portfolio in each stock. To replicate a market cap weighted index, invest in proportion of the market caps. So in the bigger market caps, invest more. In smaller market caps, invest less. The disadvantage of an equally weighted index is that you will need to continually rebalance. So let's say that you invested $100 in each stock. Stock A subsequently went up by 20%, stock B remained flat, and stock C went down by 20%. So the value of the portfolio will become 120, 100 and 80. The total value of the portfolio is still $300. However, is your portfolio still equally weighted? The portfolio now has a higher weight in stock A and a lower weight in stock C, whereas the index at all points in time and in every period is equally weighted. So next year, if the same return happens, let's say 20, 0, minus 20, index will still not go anywhere. But will your portfolio not go anywhere? Now it will go, because you have more money invested in stock A and less money invested in stock C. So if you are to replicate the benchmark, then after every period you will have to rebalance. That is, you will have to sell 20 units of stock A and buy 20 units of stock B, so as to make or keep the portfolio equally weighted at all points in time. So these are the broad index weighting schemes that we studied. In a price weighted index, a higher price has a higher weight. Splits, repurchases and dividends will change the impact, will change the weight. They won't change the price of the index, so that adjustment we do, but the weight in the index they will change. It assumes that investor buys one share of each stock to replicate. So automatically he puts more money in the higher stock price and less money in the lower stock price. In a value weighted or a market cap weighted index, bias towards large firms that may be mature or overvalued. Indices may be less diversified for the same reason, because if there's one very big company, then a big part of the index will be just that company. So in a lot of countries we're seeing that value weighted indices are heavily biased towards the banking sector or some one sector that is big in that country. Investors may not be able to mimic if they are subject to maximum holdings in a stock. Now, for example, the risk management department is told that in any one stock, I cannot hold more than 10%. So more than 10% of my portfolio cannot be in one single stock. However, if there is one very big company that is a 20% weight in the index, then I will never be able to replicate that index, because I can't hold more than 10% of any one single stock in my portfolio. An equally weighted firm can be argued as a bias towards small cap firms, because all firms have the equal weight. So larger firms will have their weight reduced and smaller firms will have their weight increased. Required rebalancing, as we just studied, will create higher transaction costs, and if there are many small firms, then investors may not find enough liquidity to replicate an equally weighted index. So if the fund manager is not taking an active call, that is, he is simply replicating his benchmark, that is referred to as passive investing. Now passive investing can be achieved in various ways. We can simply invest in an index mutual fund, or we can purchase an exchange traded fund that has the same economic profile as an index mutual fund or the index that both of these are replicating. However, there are certain qualitative differences in the way the transactions get executed in a mutual fund or in an ETF. So a mutual fund gives the NAV once a day, whereas an exchange traded fund can be traded throughout the day. Hence, the flexibility of buying and selling is higher in an ETF. ETFs do not maintain as detailed a record keeping about each investor and when he invested, etc. Because ETF is just like a share. Anybody can buy and sell in the market. So if some XYZ buys my stock or sells it to somebody else, then the ETF is not required. Like every share, at a point in time, I may be interested in knowing who is the shareholders, but as the trading is happening, anybody can acquire the stock. As detailed a record keeping is not required in ETFs as in the case of index mutual fund. This is important because it reduces costs. In a mutual fund, there are additional administrative costs because each person's profile has to be maintained, updates have to be given, so on and so forth. ETFs trade through brokers like ordinary shares and have transaction costs to that extent. ETFs tend to be more tax efficient for a variety of reasons. First, transfer of ETF share between investors is not taxable. So if I sell my ETF shares to somebody else, then that is not taxable at the ETF level. So to the extent of my capital gains, an individual may have to pay tax, or some person may have to pay tax, but the ETF is not bothered if somebody sells the shares to somebody else. Whereas in an index mutual fund, this option is not available. If you need the money, you normally can't sell your units to somebody else because there is no liquid exchange over which they are trading. So you will have to apply for a redemption. At redemption, the fund manager will sell some stocks, recover the money in cash and give it back to you. That event is taxable for the mutual fund. So when the mutual fund sells shares, then there is a tax implication to the extent of the capital gains that the mutual fund has received. Exchange of ETF units for the underlying shares can also be done. So if an ETF investor goes for redemption, it's not necessary that he has to be paid back in cash. He can be paid back in kind. That is, I just give him the shares that I have purchased on his behalf. If I give him back in kind, then that is again a non-taxable event. When the shareholder or the investor sells the shares, then he will pay a tax depending on his own tax liability and capital gains. MFs, on the other hand, as we discussed, mean redemptions by sale of securities, which could be a taxable event. Long-term costs for ETFs are thus lower due to the differences mentioned above. ETF investor does not bear the cost of providing liquidity to other investors, or there is no cash drag. Now, in a mutual fund, as we discussed, redemption requests have to be met immediately. So as to avoid selling securities in a distress, let's say the mutual fund manager gets a big redemption today. To meet that redemption, he has no option but to sell the shares at whatever price they may be. So as to avoid any distress or a big impact selling, a mutual fund manager may want to keep some amount of his assets in cash. Problem is that if the market goes up, that cash will not go up to the same extent, causing a cash drag on the portfolio. In the case of ETFs, redemptions can be in kind. Hence, I don't necessarily have to spend. So that's a cost that the ETF investor does not need to bear. Or the impact of liquidity because of a big redemption will happen to the NAVs of all shareholders or all unit holders. Because if a big selling happens in my shares, then the value of the shares will likely go down and the NAV for all unit holders will go down. Now, indexing as well can be done in separate accounts or pooled accounts. In a separate account, I as an investor have a dedicated fund manager who is doing the indexing for me, or who is replicating the benchmark at all points in time. This definitely is a very expensive thing to do because CFAs and FRMs who will be managing my portfolios will not come cheap. So hiring one for myself will be quite a tough thing to do. So many individuals can come together and afford one fund manager who will do the replication for all of them, or who will do the indexing for all of them. That is called a pooled account. So pooling is advantageous for small portfolios that cannot afford a dedicated manager. The problem is that it becomes difficult to differentiate performances, and the manager may have to hold excess cash, as we discussed, to provide liquidity for all investors in case he doesn't want to do an impact sell on the day a redemption comes. So a separate or pooled accounts at times can have lower costs than index mutual funds or exchange traded funds. So these people will charge a fund management fees, and if you have your own fund manager who's replicating or indexing for you, then maybe he charges a lower, or maybe the cost is lesser than an index mutual fund or an ETF. Now, pooled accounts, ETFs, mutual funds are all passive strategies. So we are replicating a benchmark. Hence, at any point in time, we are holding underlying securities. Is there any harm in us lending some securities? If somebody wants to short a security and he wants to borrow it for a 1 month period and he's willing to give us a fair enough return for that borrowing, then should we be willing to lend our securities, because we are anyways going to hold it for the long term because we are passively benchmarking. So this lending and the return generated from securities lending can again be used to offset some of the expenses. Another very popular indexing strategy, or rather enhanced indexing strategy, is through the use of index futures or equity futures. So in the US, the most popular futures are on the S&P 500 or on the main benchmark of the country. Now, if I have $100 fund and the mandate of the fund is to replicate the benchmark, or for example replicate the S&P 500, I have the three options that I just discussed: ETF, index mutual fund, a pooled account, wherein I give my $100 and somebody is actively buying securities in the same proportion as they are in the benchmark to compute the return. However, can I not just invest in the S&P 500 futures today? Futures and the underlying, for the most part and almost always, have a 1-to-1 correlation, because the futures price is nothing but S e raised to power RT or S into 1 plus R to the power T. So as spot changes, the futures will also change. Instead of replicating the benchmark, which may be cumbersome to do, calculating the weightages, etc., just buy the S&P futures. If you have $100 of the portfolio, to buy this futures, how much money will you need? Only the margin money? That will be much lesser than what your portfolio size is. So let's say even if 10% you have to give up as margin, then $90 is still available for you to use elsewhere. So what you can do is that buy S&P futures as the replicating strategy and invest the $90 at the risk-free rate or in treasury securities so as to give you an enhanced return. So this is another enhanced indexing strategy wherein your expected return is higher or slightly higher than the benchmark, because you are replicating through the futures and using the portfolio to generate additional risk-free rate of return. Problem, however, is that futures are normally not available for the long term. So you'll have a 1 month future, you'll have a 3 month futures, after which liquidity will seriously start to drop. So if it's just a 3 month future, then it will be too much management required, because you will have to roll it over. After every 3 months, you'll have to buy another 3 months of future and another 3 months of future. And there was a problem earlier that you couldn't short if there was an uptick rule, but it's not an issue anymore. So basically liquidity could be limited in futures for other reasons also, but the main problem is that they need to be rolled over and long-term futures are not available. We can also purchase an equity total return swap. So as long as I have a counterparty who is willing to enter into such a swap, what I can simply do is that exchange the returns on the index. So the counterparty B will give me the returns on the index and I will give him a fixed rate of return. So if I have $100, for example, I can invest the $100 in a treasury security and earn 5% or 10%. I promise to give B that 5% return in exchange for the returns on the index. So B will give me whatever is the return on the index. If there's a loss, then I'll have to give him something over and above the 5%, or whatever is the profit in the index, B will give me. So again, I have replicated the benchmark by entering into an equity total return swap. So swaps returns on a security or a benchmark for the returns on an index. So I give him a fixed rate of interest, or I give him the returns on one particular stock and he gives me the returns on the benchmark. So investor can synthetically diversify in just one transaction, I'm getting the entire return on the benchmark. I don't have to individually buy the stocks and replicate the benchmark on my own. So cheaper than trading in individual stocks. And sometimes if the structure is done by a broker who is based out of my own country and I want to replicate the benchmark of another country, if I actually went and replicated the benchmark by purchasing the stocks of that other country, when I was selling or repatriating my money, that country or that government could apply a withholding tax. That is, any dividends going out or any money going out of my country, there is so much 1% or 2% being levied. If the swap dealer is in my own country or whoever is entering into the swap, then all these issues can also be avoided and it may be a more efficient transaction for me. Important thing is I should find a counterparty or a credit-worthy dealer who's offering such swaps. So again, what we've studied up till now is the passive side of equity investing. My portfolio on the equity side is fixed and I have to replicate that portfolio. To replicate, I'm indexing. I can buy a mutual fund, I can buy an ETF, I can hire a separate fund manager who is indexing for me. I can do it through futures, I can do it through an equity total return swap. If I'm indexing myself, that I'm replicating the benchmark myself as a fund manager, then I can follow the strategy of full replication. Full replication means buy exactly the percentage of every stock that is there in the index. So buy the exact same percent as it is in the index of each stock. Now this can be done only if stocks are less than 1000. Actually, even 1000 is an exaggeration. It can be done only if there is a relatively lower number of securities and there are liquid securities available for me to do this. And the fund manager needs to have a lot of funds, because with smaller funds, as he replicates, it may become tough, or the index size may be much higher for him to replicate the whole benchmark because of the stock prices. To buy, you can't buy half a share, you have to at least buy one share of every stock. So he needs to have sufficient funds. Advantage is that very low tracking risk, you're practically hugging the benchmark. Lower rebalancing. Rebalancing will only be needed when the index pays a dividend and that dividend has to be reinvested. Otherwise, as the index values change, values in your portfolios will also change, or your index at all points in time will be benchmarked. Disadvantage is that this will always underperform to the extent of the admin fees, any cash drag if you're keeping some cash to meet redemptions, and the transaction costs of rebalancing, that is reinvesting whenever the index pays a dividend. So cash drag we studied is the funds set aside to meet redemptions. What you can do is, instead of a full replication, go in for stratified sampling. That is, first break your index into cells or into different dimensions, pretty similar to what we studied in fixed income replication as well. So we see how many steel sector stocks are there, how many auto sector stocks are there, so on and so forth. Similarly, we can have how many steel sector stocks with a P by E of 10 times, with a P by E of 15 times, etc. We can have different cells. And let's say there were 4 steel stocks with a P by E ratio of 10 times. Then in stratified sampling, the total weight of each cell I maintain as it is in the benchmark. So if the benchmark has 5% weight in steel stocks with a P multiple of 10, then in my portfolio also I will have 5% of the weight in steel stocks with a P by E multiple of 10. However, instead of buying all these 4 securities, I will buy the one most liquid securities and take a 5% position in that. So what this does is that it enhances the investability of the index, or it is particularly useful when some index stocks are highly illiquid and it's very difficult to replicate them. So there are big stocks in indices which are like 90%, especially in emerging markets, 90%, 95% held by one company or the government. So in such cases, replicating them becomes difficult. If government regulations restrict concentrated investing, then again stratified sampling can be used. So if there is one stock that is a very heavy weight in the index, but I can't invest more than 10% in any one security, and that stock is 20%. Then to meet the 20% weight, I will invest 10% in this stock and another 10% in similar stocks, which may have a lower weight right now, but are economically speaking similar, that is in the same sector, have the same valuation profile as this stock. So again, that can also help meet my mandate and still to a big extent replicate the portfolio or rather the benchmark. The third indexing strategy is referred to as optimization. So optimization is similar to the multi-factor strategy that we studied at fixed income. So we said that replicating the benchmark essentially means replicating the risk factors. That is, our portfolio should move in the same manner as the benchmark. Now, if my portfolio moves in the exact same manner as the benchmark, if the benchmark goes up by 10%, my portfolio also goes up by 10%. If the benchmark falls 10%, my portfolio also falls 10%. However, I don't have the exact same stocks. Does it matter? It doesn't, because I want my return to be the same as that of the benchmark. Now, the return on the benchmark or the return on the market for an equity portfolio will depend on what all factors? It will depend on the GDP growth. It will depend on inflation. It will depend on the valuation. It can depend on various other factors. So what I do in an optimization strategy, please understand, is that I have the historical returns on the benchmark. I have the historical GDP growth rates. I have the historical inflation data. I have the historical PE multiple and whatever other relevant factors are there. So what I do is that I construct a regression and I compute the exposure or the sensitivity of my benchmark to each of these factors. And then my job simply is to construct a portfolio that has the same betas to these factors as the benchmark. So whatever portfolio I am creating, even that portfolio's historical returns will be available to me. The historical GDP, inflation and P by E is also available to me. So the portfolio should also have the same B1, B2 and B3 as were there for the benchmark. Then as fundamental factors change, that is as GDP growth changes, as P by E multiples change, as inflation changes, or whatever factor that can affect the benchmark changes, similar impact will be there on my portfolio as well. So this type of a replication strategy is referred to as optimization. That is, using a factor model to match the factor exposures of the fund to those of the index. So because we are doing a regression type model, we are automatically considering the standard deviations, covariances, unlike stratified sampling, where we assume that the correlation between risk factors is 0, or we don't consider the individual risk factors. We basically just pick one or the liquid stock from each cell. So this will have lower tracking risk, especially with replication. So optimization with replication means that for the few large stocks that are there in the benchmark, we exactly replicate, because they are easy to replicate also, there's not much problem. For the remaining 100, 200 stocks that have smaller weights, I don't exactly replicate, rather I do the optimization process that we just discussed. So if we follow a strategy like this, then definitely we've seen the tracking risk comes out to be quite low, and even the executability of the portfolio is much better. Disadvantages Historical sensitivities may not work in the future, and it may give a misleading model and may require frequent rebalancing if sensitivities change too frequently. So what are the different active equity styles of investing? In value investing, the investor focuses on low price to earnings stocks or low price to book stocks. The hope here is either of an earnings revival, or you don't want to be in high growth stocks which are overvalued or you're expecting a disappointment in. So value investing invests in value stocks that have lower multiples or lower valuations. Within value investing, there can be high dividend yield investing, stocks which pay high dividend per share as compared to the price per share, expecting the high dividend will continue. Low price multiples as we studied. Or a contrarian approach, that is temporarily depressed firms that are trading less than book value. So what shareholders have invested in the firms, the value of the firm today is significantly lower than that, is also a part of the PYB is less than 1, is also a part of value investing referred to as contrarian. So you believe things are not going to be as bad. In growth investing, the focus is on the denominator in the PE ratio. So you're hoping that higher growth will continue to drive prices higher. So even if the multiple remains where it is, as the growth keeps happening of 20% in the stock in the earnings, the stock price will also keep going up by 20%. So you can have a consistent earnings growth strategy, that is you invest only in companies that have had sustained growth in the past and will continue to have sustained growth in the future. In momentum investing, stocks haven't had such a good or sustained earnings growth, but right now the earnings growth and for the next few years the earnings growth appears to be quite good. So you invest in these stocks, however you exit as soon as you see the momentum breaking because you don't have confidence in a sustained growth momentum. In market oriented investing, you are neither value nor growth. So you are normally given an index and your job is to outperform that index. So you can follow a low cost indexing strategies and tilting slightly towards value or slightly towards growth in order to outperform the benchmark or outperform the index. So market oriented with a value tilt will invest more in low P by E, low P by B stocks. With a growth tilt, will invest in high growth stocks. And growth at a reasonable price is also a possible strategy wherein we want to see some value also and some growth also in the stocks that we invest in. So normally a market oriented investor will have a benchmark that he has to replicate or he has to outperform. Equity styles can also be based on the market caps of the stocks that you're investing. So a small cap fund manager or small cap style believes that small cap stocks outperform or give better returns, so they have a higher weight on small cap stocks. A micro cap is an even smaller company or even smaller set of companies. Mid cap investing and large cap investing can also be different styles of investing in equities. So very importantly, we'll now try to identify the style of a fund manager from his returns or from his holdings. This is very important because if deviation happens from our stated style, then it can be detrimental to our risk return objective, as we will see in the coming slides. Now, the first way of identifying a fund manager's style is called a returns based style analysis. So we first identify the various styles that the fund manager can potentially have, or we understand the various benchmarks that exist. So for example, the style could be small cap growth, large cap growth, small cap value, or large cap value that the fund manager could potentially be following. It could be a mix also. but independently it could be one of these strategies that the fund manager is possibly adapting. We have individual benchmarks available for each of these strategies. So a large cap value benchmark, as the name suggests, will have large cap stocks which have a P/E ratio of less than 10 times, for example. A small cap value will have small cap stocks with a P/E of less than 10 times. A small cap growth will have small cap stocks with a P/E of greater than 20 times or 10 times, as the definition may be. Now, we regress the fund manager's historical returns with the historical returns on each of these benchmarks and try to calculate the sensitivities to the returns. We put a constraint that the sum of B1, B2, B3, B4, that is summation of the betas, must be equal to 1, because we're trying to force that he has to follow one of these strategies. So let's say we do this regression and the best fit line or the best fit values of B1, B2, B3 and B4 come out to be as shown. So B1 is 0, B2 is 0, B3 is 0.1 and B4 is 0.9. What we will conclude with this analysis is that 90% of the fund manager's returns, or rather a big part of the movement of the portfolio, is linked to the movement of the large cap value index. So if a large cap value index moves, the value of this portfolio also moves. The movement in the small cap growth and the large cap growth index doesn't appear to be having much impact on the portfolio. There is some impact of the movement of the small cap value index. So we'll say that primarily the manager's style is large cap value. Please note, all the caveats that go with the regression analysis also apply here. So we will have to compute the R square of the regression, that is the coefficient of determination, to determine how good the fit is of the regression. We should do a statistical significance also for each of these coefficients. This method is a relatively easier method because fund managers' historical returns would be relatively easily available. The benchmarks' historical returns will also be easily available, so we just need to perform one regression to determine the style of the fund manager. What we should be careful about in doing a returns-based style analysis is, first, that these indices should be mutually exclusive. That is, there should be no stock that is a part of a large cap value index also and a small cap value index also. So that will create problems in the regression. So first, make sure these indices are mutually exclusive. Remember, a precondition of regression that we studied was that independent variables cannot be highly correlated amongst themselves. So the independent variables has to be independent from each other. Regression must be well specified. All indices must be considered that could possibly affect the fund manager. Indices should not be too broad, that is, they should be specific so that we get some answer or we are able to derive something. R square is the style fit, that is, how much of his returns are directly attributable to the indices. 1 minus this number will tell us how much is not because of any particular style, but because of his deviations or because of his stock selection and timing. Error term is again the selection return, that is the constant in the regression. So this analysis or any style analysis helps us determine if the manager's reported style and actual style are the same. If they differ, it can create problems. We will study that in a separate slide. Yeah, my apologies. The error term is not B0. B0 is the constant, probably depicts the risk-free rate or something. Error term is E in the regression. So the error term is to which the actual value deviates from the regression value or to the predicted value. You studied this in regression. So we did a returns based style analysis for ABC and XYZ funds, and we found out that the beta to large cap growth came out to be 0.48, the beta to large cap value came out to be 0.27, 0.09, so on and so forth. The total or the summation of the betas has to be equal to 1. That is why this is a constraint optimization. The constraint is all betas should sum to 1. Similarly, for XYZ, looks more like a large cap growth. 80% of the returns in the portfolio were explained by the movements or were dependent on the movements on the large cap growth benchmark, so on and so forth. Now, the returns based analysis can be done over multiple periods as well. That is, as time passes, it may so happen that the style of the fund manager starts drifting. So let's assume that we have 5 years of data from January 2003 to December 2007, that is 60 monthly data times. Now we use 36 months in each regression analysis and form 25 overlapping samples of 36 months each. The first sample is t equal to 1 to t equal to 36. So once again, we had 5 years of data available, that is 60 months. For these 60 months, we take samples of the size 36 each. So if we are taking 36 each and we start from January 2003, the first sample will be from January 2003 to December 2005, that is the 36th month. Second sample is from February 2003 to January 2006. Third sample is from March 2003 to February 2006. So on and so forth. We will be able to make 25 different but overlapping samples, each taking us one period forward. And we will again calculate the B0, B1, B2, B3, B4, assuming there are 4 indices that the fund manager potentially can invest in. If these values are significantly trending towards one direction, that is, initially the beta for large cap value is very high, but as time is passing, we're seeing that this B1 is coming down and B2 is going up. So the style of the fund manager, we will conclude, is drifting from a large cap value to a large cap growth. So an analysis of multi-period returns will help us capture style drift, if any, in the fund manager's investments. So in the first sample, we saw that 62% or B2 for large cap value came out to be 0.62. In the last sample, we saw that that sensitivity had come down to 0.5 and the sensitivity to mid cap value had gone up to 0.37. So we see some drift in favor of mid cap value invest. So these were the betas originally. We saw now that the large cap value has come down and the mid cap value has gone up from t equal to 1 to t equal to 25. Another way of identifying the fund manager's style is simply observing and analyzing his holdings. So see the stocks that the fund manager is investing in, and we'll be able to guess what is his style. So if the fund manager has a lot of investments in low P by E, low P by B and high dividend stocks, then we'll conclude it's a value type of investing. If he has higher growth stocks and high P by E, high P by B stocks, then the style is a growth style. Similarly, if he has large cap stocks, it's a large cap growth. If he has smaller cap stocks in his portfolio, then it's a small cap strategy. So high EPS growth means a growth strategy. High earnings volatility generally means a value strategy. So highly volatile firms have a lower multiple. High volatile firms means higher beta. Higher beta means higher cost of equity. Higher cost of equity means lower justified multiple or lower price to earnings multiple or price to book multiple that will be applied to these companies. So remember, if he has volatile firms in his portfolio, it generally depicts a trend or an inclination towards value stocks. Value managers have higher utilities, that is power companies, water, electricity, etc., financials in their portfolio, whereas growth managers have higher technology and healthcare stocks. So these sectors are generally considered to be the growth sectors in the US. India is a very different story, guys, okay? Utilities are very high growth for us, because we don't have water and power only. These people already have a lot of it, so that's not growth anymore, okay? India power is the biggest growth story right now, okay? So it's not India, this is a US specific discovery, or so to say, what you've seen, okay? It's a US based exam, so we have to remember this. Utilities and financials are value. Healthcare and technology is high growth. Healthcare and technology is high growth in India also. In fact, both of them are the best growth today. IT and pharma. In the figure below, the characteristics of a mutual fund and a broad market index are provided. Using only the data provided, identify the style of the fund. So he has a lower P by E ratio than the broader market, a lower P by B ratio, higher dividend yield, lower earnings growth for both 1 year and 5 year, and a considerably lower market cap than the broad market. So we will conclude that he has a small cap value type of style. Further information was also provided, which says that his weight in financials was much higher. His weight in utilities was also much higher than the benchmark or the broad index, again indicating a value type of style. Now let's see the advantages and disadvantages of each of these approaches. So for the return based analysis, the advantage is that it characterizes the entire portfolio. So we take the returns weighted for the entire portfolio. Here we look at each securities, and it is generally the tilt in the security that tells us what style it is. So we need only the return on the portfolio. That's all the data we need. We don't need much data in a returns based analysis. In a holdings based analysis, we need details of all holdings that the fund manager has and the P by E multiples, etc. of each of the holdings. Enables comparisons of entire portfolios, enables comparisons of individual securities, the holdings based method. Summarizes the result of the investment process, that is the end weighted average portfolio return matters. Holdings based, on the other hand, can detect style drift more quickly than the returns based analysis. We saw in the returns based analysis we needed 25 samples over 2 years of data to figure out if there is any significant style drift when the beta started differing. In a holdings based analysis, I can easily look at the holdings and tell that he has reduced value stocks and added more of growth stocks. Methodology is backed by theory, that is sensitivities are clearly seen. Here there is subjectivity involved as to what is value, what is growth, etc. Low information requirements, I just need the returns. Different models usually result in the same conclusion, has lower cost and can be executed rapidly. That regression can be quickly performed because index data and portfolio data of returns will be easily available. Even though portfolios may not be available at times, the returns have to be reported by everybody. Disadvantages: The returns based may be inaccurate due to style drift. As we saw, it doesn't capture style drift very quickly. Misspecified indices can lead to misspecified conclusions. Holdings based analysis is not consistent with the method used by many managers to select securities. That is, they don't really want to have a tilt in a large cap value or anything like that. That is more what comes out from his bottom up analysis. So if more of his stocks turn out to be, or higher returns of stocks that turn out to be in the value type of category, then he'll be called a value fund manager, wherein he may not have gone out looking for value stocks. From his overall analysis of risk, return, growth, valuation and stock price, it just so happened that it's the value stocks that have come more in his scenario. Next year or next month, a different or even a growth stock may come depending on whether the stock price falls or stock price goes up. Requires subjective judgment to classify securities and requires more data. I need the P by E, I need the valuation, growth expectations of all stocks in the portfolio and the benchmark. So a company called Morningstar has developed an equity style box to help identify a fund manager style. Again, a holding based analysis which says that construct a grid which has value, core and growth as the 3 columns and large cap, mid cap and small cap as the 3 rows. Then analyze the holdings on the portfolio and see what percent of the portfolio lies in large cap value, large cap core or large cap growth. What percentage lies in mid cap value, mid cap core and mid cap growth, and what percentage lies in the small cap category. Once you've filled in this box, after analyzing the holdings of the fund manager, you will be able to conclude his style, whether his style is small cap value or mid cap value or whatever. So in this case, we see is a small cap value and some mid cap stocks also he has. So small and mid cap value holdings primarily dominate the portfolio. We have to be careful about style drift, because if there is style drift, then first of all the investor does not receive the desired style exposure. If the large cap fund manager also starts investing like the mid cap fund manager, then there will be over allocation to mid cap securities and under allocation to large cap, because he would have other mid cap managers as well, and the large cap manager's job was to invest in large cap securities. Secondly, the manager may be moving out of his or her area of expertise if she is drifting from her stated style or from her historical style. So these are 2 reasons why we must be careful about style drift. Guys, a lot of times the client may mandate a socially responsible investing. So normally this has something like a negative list, that is stocks wherein you are not allowed to invest in, tobacco companies, alcohol companies, etc. Sometimes it can be a positive socially responsible investing, that is you go out seeking companies that have good corporate social responsibility or good ethical values, etc.